49% of homeowners are currently struggling to make their mortgage payments, according to Redfin. And because of this, I have a lot of homeowners reaching out to me asking me what they can do. So in today's video, I want to talk about why this is happening, how it could ultimately affect the housing market, and what possible solutions you might have as a homeowner if you're currently struggling. If you're currently feeling the squeeze of rising housing costs and wondering how you're going to make ends meet, then this video is for you. Approximately half, 49.9% of homeowners struggle to afford their housing payments, according to a survey by Redfin. And it really comes down to a couple of different factors, which in some cases are out of your control. But one of the things a lot of people have heard over the last couple of years is that you should marry the property and date the rate, with this idea that you should find the right property, not worry about where interest rates are at the moment, because there's always this opportunity in the future, and likely really soon is what a lot of these people were promised, that they could refinance. So you should just find the right property right now, not worry about the rate, and that at some point in the future you're going to be able to lower your housing payment. Well, unfortunately for a lot of those people, what we've seen is interest rates actually move higher. And because of that, a lot of people have been dating this interest rate that they've been struggling to make the payment on for a much longer time than they had originally anticipated, which is putting some in a position where they can barely make their payments. In fact, I had a borrower reach out to me recently here in Southern California that wanted to sell his property because the total monthly mortgage payment just ended up being way more than he could actually afford. So if you're in that position, we're going to talk about solutions at the end of the video. Now, in addition to rising mortgage rates, what we've also seen is rising property taxes as well as insurance costs. If you take a look at this chart here, this is 15 counties that saw the biggest 3-year increase in median home insurance premiums between 2020 and 2023, with the top county being up over 150% in just 3 years. In fact, if we scroll all the way to the bottom, number 15, their cost is up nearly 65% in just 3 years. And unfortunately, if you're in Florida, 9 of those 15 are actually located in Florida. So on top of rising mortgage rates, we've also seen rising insurance premiums. In addition to property taxes, as homes become more and more expensive, you're likely going to end up paying more and more in your property taxes because of the way those taxes are adjusted. Now, fortunately for those that live in California, we have something called Prop 13, which limits our property taxes from increasing based off where we originally purchased that home. But unfortunately, most states don't have that limit. And because of that, housing costs are continuing to increase. And if that wasn't enough, if you happen to live in a condo, then chances are you've also seen an increase in your HOA per month, which is leading a lot of people to wonder if it actually makes sense to keep their current home. Now, while I do believe that everyone should own a piece of real estate at some point in their life, you shouldn't be doing it if it causes you stress, if it causes you angst, and of course, if you can't afford the monthly payments. Now, while I do think the housing market is going to slow down, I personally don't believe that housing prices are going to crash or that housing is going to become way more affordable anytime soon. And that's because housing affordability is really made up of only 3 things, with the first one being house prices. And at the moment, house prices are continuing to increase year over year, with Case-Shiller showing an annual appreciation at 4.2% year over year, along with the FHFA also showing that home values went up 4.2%. And while I do think this is going to slow down, I also believe that it's very likely that you see continued growth in home prices over the next couple of years. Now, in my opinion, it's not going to be what it's been over the last couple of years. You're not going to see 5, 7, 10% in most cases, but you are likely to see 2 to 3% going forward, which means unfortunately that's not going to help with affordability. Now, the next leg of that stool is wage growth. And fortunately, what we're seeing is wages continuing to grow, which will ultimately help with affordability. But for most people, it's not going to increase enough in order to have a big enough impact. But the third leg of the stool is the most important, and that's mortgage rates. And while we have seen mortgage rates come down from 8.1% last October to around 6% just a couple of weeks ago, unfortunately, we've seen mortgage rates move back up, with this idea that if Trump gets elected and his agenda gets through Congress, that it's going to be inflationary. And because of that, it's leading a lot of people out there to believe that interest rates might actually stay higher for longer. So until we see an economic slowdown where unemployment starts to rise, jobless claims go up, while the Fed cuts rates and mortgage spreads improve, you're not likely to see interest rates move much lower, or at least not in a meaningful way that would make housing more affordable. And because of that, you have many Americans out there resorting to various measures to manage their housing costs, with 35% taking fewer or no vacations at all. On top of that, you have 22% of people skipping meals, nearly 21% of people are working extra hours, along with 21% of people are selling selling belongings, in addition to 18% of people borrowing money, nearly 18% of people pulling money from their retirement, in addition to 15.6% of people either delaying or skipping medical procedures. And they're doing all of this to save money, while at the same time putting more and more money on credit cards. So this probably has you asking, how will this affect the housing market? Well, that's actually where I want to reach out to you. Let me know in the comments below how you think all of what we just talked about might actually impact the housing market. Well, in my opinion, the very first thing that's probably going to happen is you're going to see inventory increase. But here's the thing, it's not going to be a nationwide increase in inventory for the most part. It's going to be in areas that are impacted the most by the things that we mentioned earlier. Rising insurance costs, rising HOA fees, rising taxes. And it's also going to impact the markets that have already had that increase in inventory. And these markets, in my opinion, are areas like Florida, Louisiana, Texas, because not only have they already seen this increase in insurance and taxes, but they're also seeing natural disasters, which is likely to lead to even higher fees in the future. And along with this increase in inventory, depending on where inventory is, it's likely to push prices flat or even lower in some cases, especially when sellers purchase with little to no money down. They're having trouble paying. They're already having trouble making their mortgage payments. There's very little equity in their property, and now they've got competition in that market. And with that, it's going to make some of these properties even harder to sell. And because of that, it's going to lead to price adjustments. Sellers are going to have to reduce prices in markets where supply outweighs buyer demand. Now, for the most of the United States, this probably isn't going to be an issue, as in my opinion, is probably going to be a little bit more isolated to those areas that are impacted by the things that we mentioned a moment ago. But in addition to that happening, you're going to have the market shift. It's going to become a more buyer-friendly market in areas with increased inventory. But at the same time, it's probably going to put a shift in buyer behavior. Buyers are going to be more cautious as costs continue to rise. At the moment, we have inflation sitting somewhere between 2 and 3%, which means the cost of goods are continuing to increase annually. So in addition to housing costs, you also have the cost of everything else in your life going up. And because of all of this, is likely to push more buyer demand towards more affordable housing. And that's essentially what we've seen, is the houses that are at or below the median home price for a certain area continue to sell, and they usually sell pretty quickly in a pretty quick amount of time. But the homes that are above that median home price, the homes where it's getting more expensive to own, you need larger down payments, along with the homes that are overpriced, are the homes that are sitting. And that's why it's really, really important before you buy a home that you set a realistic budget. You've got to factor everything in and not just look at your housing costs. What I see is a lot of people living in the payment that their mortgage professional told them they could qualify for, without ever really considering whether or not they could afford that payment. By doing a budget, write down all of your expenses. Yes, I'm talking about childcare. I'm talking about date nights. I'm talking about what you spend going to yoga and to the gym. Factor all of these things in and then determine a realistic budget from there based on what your payment is going to be at the time of closing, not with this expectation that mortgage rates are going to move lower and that you're going to be able to refinance and lower your payment. See a lot of people buying real estate right now with this expectation that in the future it's going to be less expensive because rates are going to come down. Now, I am a firm believer that interest rates are going to come down, but here's the thing, they haven't come down nearly as quickly as I thought, which leads me to that saying that things can stay irrational longer than you can stay solvent, which basically means things can stay completely in chaotic mode longer than most people can handle it. And so while I do believe mortgage rates are going to move lower, I don't know if it's going to be 4 months, 6 months, or even a year from now. So you have to buy with the expectation that your payment is not going to become any less expensive. In fact, that it's likely to go up. On top of that, you want to make sure you have an emergency fund, that you have money in the bank outside of your down payment, outside of your closing costs, just in case for that rainy day, if you lose your job, if your spouse loses their job, so that you're not in a position where you've completely overextended yourself. And the last thing you have to consider is you have to have that longer term time horizon. You need to be thinking 5, 7, 10 years from now. Not tomorrow, not next week, not 2 years from now. And that's because a lot can happen in a 2-year period. But once you have a longer term view, you're less likely to be upset by what happens in the short term. But let's say you are one of those people that are overextended on your mortgage and you're wondering what are your options. Well, the first thing I want you to consider is refinancing. Are you at an interest rate where it makes sense to refinance? Now, for those of you in the low 3s and low 4% range, that's not going to be an option. But if you're somebody that purchased a home and the rates were 7%, 7.5%, even 8%, there might be an opportunity out there for you to refinance and actually lower that monthly mortgage payment. Now, the solution isn't to pull cash out of your property so that you can continue to hang on and hang on and hang on, unless you have a way out of that at the end. While I don't mind the idea of refinancing your mortgage to lower your cost, I don't like the idea of putting a bunch of cost in your loan in order to save a couple $100s per month. And that's because essentially you're giving away your equity. Now, in some cases, that might be a viable solution for you, but I want you to consider some of the alternatives that we're going to. But at the same time, I'd also like you not to use that as your only option unless you have a way out of it at the end of the day. If it's only keeping you hanging on for the short term, then it's probably not worth it. Which leads me to the next thing you probably want to do is contact your lender. Have a conversation with them. Tell them that you can't make the payments. Now, I'm not talking about the broker that did your loan. I'm talking about the company that actually holds your loan. Wherever you get your mortgage statement from per month, I want you to call them. I want you to tell them exactly what's going on, that you're having difficulty making the payment. Tell them why. Maybe you lost your job, whatever happened. You got to be real with them, because in some cases they might offer you some sort of loan modification for a short period of time. They might offer you a forbearance for a period of time. And while some of these things might not be a permanent solution, it might give you enough time to figure out another alternative where you can actually keep your property long term. And obviously the last thing that you should consider is selling your property. But before you sell your property, I want you to stop. I want you to go out there and look at rents in the market. What's it going to cost to rent what it is you're looking to rent? Right? How does that compare to your mortgage payment? On top of that, are you in a position to sell your home? Do you have enough equity in that property with the cost to sell that property? Selling a home isn't free. There's always costs that you're going to incur when you sell a home, and you have to factor that in. So before you go sign a contract that you want to sell your home, you should get some sort of closing statement showing what you're going to walk away with, what fees you're going to pay. You need to make sure that there is housing out there that suits what you need for a price you're willing to pay. If, say, for example, your mortgage payment now is $5,000 and what you're going to rent is $4,500, is it really getting you what you need? So before you make any sudden move, just make sure you've considered all of your options. Don't make irrational decisions just because you feel like your back is at the wall. Understand that lenders don't want your property. They're not looking to take your property from you. In many cases, they're willing to work with you, but it all starts with you taking the first step. Now, if that first step doesn't work, then you can consider selling your property or doing whatever you need to do in order to get out from underneath that payment. And the last thing I'd like to say is don't beat yourself up. There's always a solution. You're not alone.